All right.
Let me see. There's a possible way to do that.
I know it was earlier I had this. Okay. 1 second here. What I made is do is just make you the host, which would be fine, and I think I can work from there.
Yeah, I think we could be co-hosts.
Yeah.
Cool.
Okay, so let's do it. All right, I think for now I'm gonna make you the host, and then we'll figure it out from there. To be able to make me the co-host, that's fine.
Yeah. Okay, let me see if I can share the screen here. Great. Okay, good. All right, it looks like I am able to. Spotlight. You know, it's funny. We've been doing all these in-person events recently. It's almost like forgot how to use Zoom.
Yeah, and I use Teams at work, so I'm always on Teams now. I'm actually not on Zoom anymore. It's funny.
Yeah. Yep, that's right. I think I guess I could pin myself. Is that everybody sees me?
Yep.
Okay, great. All right. Well, thank you for all 10 of you. Appreciate you guys coming out on, I guess, wow, Thursday already. Thursday night, almost 8 o'clock on the East Coast. Seems like everyone's on Eastern Standard Time. My name is Anthony Scandariato, as Jerry mentioned. I'm one of the co-founders of Red Knight Properties, which is a boutique middle market multifamily investment firm and also a management firm. We have in-house property management. We have about 1,000 units in our portfolio between 6 different states, up and down the East Coast, anywhere from where we are in New Jersey, which is where we started, and that's kind of what we're going to talk about. How it all started tonight in local New Jersey, where Jerry and I and Mark and a couple of others on here sit, and kind of expanded into other states. We're in the Sun Belt now, and you know we're getting into the Gulf Shore. We're in the Midwest, so kind of all over. We act as general partners as well as limited partners, so kind of have that dual effect, which is really cool. And it have about, in terms of assets under management, it changes all the time, but probably if I had to put a number, maybe 120 million, give or take. And been around since 2016 with my company Red Knight, and really taken off over the past few years in terms of growing our unit count and getting into bigger deals. We do both the joint venture, like direct partnership model, and also the syndication model. I'd say 70% of our business is syndications, and then 30% are just kind of direct ownership, internal capital. So yeah, thanks again for everyone coming out. So Jerry, I don't know where you wanted me to go with this. I do have a presentation, kind of like almost like a case study of, you know, where we were and how we took the property, how we grew the NOI, how, like what we did, refinancing and selling, like who the buyer was, and how we were able to generate basically a 2x return. It was like a 53% internal rate of return over, I think it was, I want to say it was like 2 years, Jerry?
Yes. For you know, for me, I remember because it was interesting when I found out, I guess, about your firm probably at the end of 2019, and I went to see you speak actually at Jason DeRussi's meetup in January of 2020. At that time, I didn't know Jason at all, and I just went there, kind of listened to your presentation, shake your hand, and give you a call another day. And I missed I think it was, we connected on a walkthrough in March, which, by the way, was something that I always remember because, you know, limited partner my first time, and you know, you took the time with me, and there was another investor, and we walked the property and the other property that you had in town, which was a great opportunity. So then that was March 2020, and then something crazy happened about a week later. Actually, I think we were at the point where we were pounding, wasn't shaking hands. Yeah, because things were kind of getting a little, unsure.
I think it was early March.
It was
Yeah.
early March, correct? Yeah,
Yeah.
and I think it eventually closed in July of 2020.
That's right. It was a pretty delayed closing, although not that delayed because deals are getting delayed even further now, as it was during the pandemic, which is crazy to think about. But that's just the way the world works. So yeah, so I'm happy to share my screen. I think I have access to do so.
Where was the property?
So the property is, so I'll show you right now. Can you guys see my screen? This work?
Yeah.
Perfect. All right. So the property was in New Jersey.
I got one question before you start.
Go ahead, Howard.
I'm just learning. I'm brand new in this, and they're saying really not to invest in the Northeast because we're not landlord-friendly states. Have you found a big difference in the not, in the landlord-friendly states compared to down south?
I'll put it this way. We're not buying any more in the Northeast.
Okay, enough said.
Can I answer your question?
You got it.
Okay. Excellent. Yeah, so this was part of the original deck I put together when, we were first trying to figure this deal out and put it together. This was part of a syndication, which is why, Jerry was one of the partners in this deal. Still remains a good partner of ours in other deals. And love to get involved in some of the Carolina stuff at some point. But yeah, this is where we started in local New Jersey. This is about a half an hour from my residence and my partner's residence. It was 64 apartment units, 2 properties, 2 32-unit properties about a mile from each other in a county seat, about 50 miles outside of Midtown Manhattan, just to put it on a map. Closed in July of 2020, refinanced the asset in 2021. We're able to give back pretty much everybody's capital. We did everybody's money in 2021. And then we sold it in about a month ago on October 20th. So I already told you what we do. You don't need to hear about me. I already introduced myself. But yeah, this is the case study. So yeah, it acquired 64 units. We bought the asset. It was on the market with the broker. The buyer couldn't perform, fell out of contract, wasn't really marketed that well. And we just bought an asset in the area, 51 units actually behind these 2 properties. And that's where I met Jerry to kind of show him through our existing property. And we were able to take it down. It just, again, it took a few months longer than we wanted. But we were able to get the rents up pretty much within a 14-month period by over 30%. And that's where we're able to do a cash out refinance. We literally got back everybody's money. And then, yeah, it was about 2x over 27 months. So a little over 2 years. And feel free to raise your hand, interrupt me at any time if I'm going too fast or not understanding something. So feel free to do that. But yeah, the original transaction, we bought it for $7.3 million. Which was about 114 a unit. It was almost a 7 cap. If you guys remember interest rates at that time, long-term rates were like 4%, 4.5%. So it was actually pretty good because cap rates weren't even this high back then. And we ended up putting in about $300,000 a unit. And basically a lot of the money was spent at one of the properties, or Stonewood and Swartzwood. Most of it was interiors. We redid the parking lot, put new signage in. There was some deferred maintenance, but most of it was interiors. I have some pictures of before and afters at the end I'll get to. But, we were able to grow the net operating income from that $500,000 number to a little bit over 600. Say it was 604,012 exactly. So these are like the actual numbers. We really liked the deal at the time because it was, first of all, it was local to us. Second of all, we had closed on an asset a few months before. So, getting economies of scale with over 100 units in the area versus 64 is much better. We had 1 maintenance tech. 2 leasing agents, and like an assistant maintenance tech too. So able to spread those costs around, leverage the vendor relationships, which was awesome. And the assets, the reason we liked them, they weren't professionally managed. It's kind of awkward to manage a random 50 or 60 unit when the owners live in Florida and don't own anything else, like at all. They're not ever up here. And so we just, we saw how low the rents were. At the time, they were about 18% below market. We got them up even more than what, we thought the rents were at the time. And, this area of New Jersey is a little bit more rural, and it's part of Highlands Preservation Act, which, there's pros and cons to it, but there's not a lot of new development, but there were a lot of jobs coming in the area. So we figured, this area, in terms of kind of rent growth projections that different data sources were giving to us, and just being local to the area, we just knew, there's going to be a demand for housing, and it's just going to put upward pressure on the rents, which it did. So for those of you who weren't familiar, it's, charming downtown New Jersey, a lot of economic drivers, which is why we liked it. Literally community college, like 3 different schools, 5 different schools, downtown area, county seats. You got the government in New Jersey. That's not going anywhere. You had local banks, you had Home Depot, Walgreens, big box stores. So a lot of just different employment, blue collar, I'd say, bases that we liked with the type of tenant profile we were targeting at the time. More developments to try to extend the train line out there, and there's some other, downtown stuff we liked going on. But anyway, just high level, which I'm sure all you're curious about, is, bought it for $7.3 million. Okay. The first year, we yielded about an 8% cash on cash return. Put in, actually, that should be 300,000, not 500,000. That's my mistake. And then, a year later, we refinanced our existing debt of $5.7 million. I think our rate was, when we closed, it was like 4.5%. So we put on new debt. We grew the net operating income to a little bit over 600. Property appraised for 10.6 million. So we took out a new loan of 8.5. So you kind of do the math, you're paying off the old loan, and then figure out what the initial down payment is. It actually was almost a 1-to-1 ratio. So that's why we were able to give back everybody's money. We put on debt that was assumable to the new, if anybody wanted to buy it, which somebody did, basically meaning you can transfer the existing loan. So our rate was 3.64%. You can't get that now. So the buyer, in October 20th, it was a local buyer, lived about 10 miles from the property. He had a 1031 exchange requirement. He sold out of a larger property in New Brunswick. And he was going to pay, I think the number was like $15 million in capital gains taxes. And one way he was able to, defer that was to acquire this, along with some of our other properties. And this was just one of them. So purchase price. So we sold it for $12 million. So bought it for 7.3, sold it for 12, and did all in around 7.8, let's just call it. So kind of do the math, it's almost double, close to it, over time. And we liked the deal because just the numbers worked originally. Like, nobody was expecting rates to be at 3.5%. These were kind of like our original projections. And then what ended up happening was this ended up happening. The NOI was 604 versus our, 585 after 3 years, because that's what we were projecting. So definitely was a big increase, and cap rates really compressed at the time. So in terms of the work we did, this was our exact capital budget here. We did the parking lot. We spent about $46,000, $160,000 on unit renos, $25,000, $23,000 on monument signage, and some other renos and some other miscellaneous expenses. So that's our exact number there. So we're able to spend that money, and it rewarded us. The average rents at the assets were $1,103. We're able to get them to, it was around, the average was over 1,300. This is a little bit dated, this presentation, but we just knew going in that the rents were so low to begin with. There was no way we can go wrong on this deal.
Was it
know,
100% occupied?
It was we bought it, it was 97%. When we sold it, yeah, it was like 95, 97, hovered around there. But when we were analyzing the deal, we just looked at the comps in the area. We saw, hey, this one bedroom, I think this is actually up to like 1550 now. But they weren't even getting close to that. So that's really why we like this deal. It just, when we look at deals and we look at comps in the area, the comps have to be there. We don't want to be the ones making the market. So it just, the intrinsic value was just there. It just needed to be remanaged and, renovated. So those were some of the comps we used to make sure this was a good deal. And I kind of mentioned to you guys, no new deliveries we saw coming up, and the vacancy rates was really low. The 12-month asking rent was this is before COVID, was over 4%. And the average for North Jersey was 2%. So it was above, the North Jersey average. And we knew some other jobs were coming in. So, yeah. And we looked at the sales comps too. So not just the rents, we always look at what other properties are trading for in the area. We knew the highest traded asset was almost 200,000 a unit. A little bit newer construction was like 2007, and ours were like built in the late 70s, early 80s. So different asset type, but hey, it's still there. So we knew there was room to really grow. I think the per unit price at the 12 million is like almost 180,000 a unit, maybe a little bit less. So we're pretty close to that. But these are what the units look like when we took it over, and they all look like this when we were done with it. We renovated, I think, almost 70% of them, and the rest we just got the organic rent lifts without really doing that much. But that's the long and short of my presentation. I know I said a lot, but I hope it kind of just very simply painted a picture of what we did here. And we're really happy about it. We're fortunate to have good partners like Jerry and others. And yeah, this was our second syndication we did. So we're happy that it wasn't a dud. So I'll stop sharing my screen if there's any questions or just kind of want to have a dialogue.
Yeah, thanks. And I'll kind of kick off right here, because especially, looking at this as a perspective of the limited partner, the investor, having gone through the process. One thing when I learned through this, that kind of the power of compounding within, investing, where, this was a 5 or 6B, I believe. And, but it was, I don't know, the minimum was 50, but I know, typically a lot of these, the 50,000 investment, let's say, when you returned that capital, though, you also had an opportunity to go into another deal. And that was something that was really appealing. So I guess it was September of 2021, I guess 13 months later, 14 months later, then you also had an opportunity to go invest somewhere else, which was in Orlando. Is that something that you typically look to do when you refinance, to give your investors an opportunity to go into another deal?
Yeah, absolutely. We timed it up. We did this on a few deals just because rates were so low in 2021. So we did this on a couple deals. We were able to refinance. Everybody got their money back, and then we rolled into something else. This was one of them. But yeah, every time there's a capital event, unless you want to wind down your business, and you're just kind of done with the industry, then yeah, just sell it and tell everybody to go on vacation. But that's not, me and my partner are relatively young guys, I think. And we're in this for the long haul. So we always try to line something up. It doesn't always line up perfectly. But it just, in this case, it did. A couple other deals, every single one of them have. Definitely tough to find deals, always is, no matter what market. But there are deals out there all the time. You just got to hustle.
Excellent.
How are you finding them?
We would say all of them are through the broker relationships. Yeah.
No direct to seller?
Yeah. I mean, when we do direct to seller and mailers for, well, our deal size is anywhere from, this one was 7.3 million. So it's a little bit on the smaller side, actually. For us, ours are usually 10 to 20. Like if I got a mailer, I'd throw it out. I get mailers all the time on, especially our Florida properties now that we own. I just throw them out. So, you know, it's usually through the broker relationships for the, I would say 5 million and up. Sometimes you get a one-off, which is awesome. But yeah, usually through the brokers, and they don't show you the deals unless, you know, you've closed on other deals before. We never would have saw this deal if we didn't have another asset in New Jersey, next to this property. So, you know, it just, the relationships and your reputation really matter. And you just got to keep it going.
Question for you, Anthony. You talked about pivoting in geographies and things like that out of the Northeast. Are you, I know a lot of operators out there are talking about pivoting up in tenant quality, up in, you know, vintage of the buildings. So looking for newer buildings, things like that. Just given that we're heading into possibly a time of uncertainty here. Are you looking to do anything like that? Or is it kind of just, this is your bread and butter, this is what you made money on, and, you know, kind of the same strategy going forward?
Yeah, we have some, I mean, these are, I would consider these workforce housing properties. We took them up. They were C- and now they're C+. Okay, so they're not dogs. They weren't dogs. They were good at, you know, they were decent quality housing for really blue collar workforce. But they just haven't been updated in like 15 years. So that we just came in there and updated them and got the rents up. So we do like that model, and then we got out of it. We are buying some like late 80s product right now, but the story doesn't change. We're still buying from mom and pop that's owned for 15 plus years. The story hasn't changed. I think one of the reasons why we sold, number one, because we thought the price was ridiculous, and to be honest with you, the buyer's kicking himself. I kind of heard that through the grapevine. You know, number two, yes, it is an older asset. There were some deferred maintenance we didn't take care of, and we knew about. We did disclose it, so it wasn't anything unknown to the new buyer. But that could really eat your cash flow in the long term. You know, if you got to replace a roof, you got to replace boilers, you got to deal with, you know, like you mentioned, the tenant profile, a little bit, definitely a little bit more challenging than, you know, opposed to Class B in terms of rent collections, even though I think our collections were pretty good. I think they were like 90% on this through our hold period, at least. But yeah, I would agree. I mean, for us, we, as I said to Howard before, we have some other properties in the Northeast. I haven't looked in the Northeast in a couple of years in terms of new deals. So it's challenging landlord-tenant court for sure.
Anthony,
And I'm in Albany, New York, and they're going up left and right. I'm like, who's buying these things? They're building them left and right. And it's,
We had an asset in New York State as well. It was only a 12 unit. We sold it. We did really well on that, better than this deal, to be honest with you. But that just wasn't a market we wanted to be in, because I mean, half my tenants didn't pay, to be honest with you, and it just, we could never get them out.
yeah. Yeah.
so you're fully integrated in New Jersey, where you handle the property management internally, correct? And what about out of state? Well, how do you deal with the property management of your Florida properties?
Yeah, we have in-house property management, definitely different from a lot of other syndications I've seen. We have a team, you know, I have an office, I have a staff, I have a senior property manager who oversees our on the ground maintenance technicians and leasing agents. You know, I have 2 bookkeepers on staff. It's more work for sure, but you know, we're able to control more of the operationals as if we just outsourced it to a third party. I've never had good success with that because I've always ended up managing the third party and end up doing the work. So maybe it's just the size of units we're buying, because if we're, you know, staying between 50s and 150, 200, it's hard to find good quality management. You're not going to find institutional management for it. So I think that's part of the issue. But you have enough scale, you can really grow your management company. We really didn't hire anybody until we were around 300 units in order for it to make it work. Me and my partner were going to this property, knocking on doors, cash for keys if the tenants wouldn't pay. Like, you know, Section 8, like I literally went to the Section 8 office to negotiate with them. Like, I don't do that anymore. But it was a great learning experience, and highly would recommend that for somebody looking to get started. I saw a quick question in the chat from Randy. How did you manage to do renovation when the units were 97% occupied? Yeah, we bought it. They were 97% occupied. And then COVID happened. And then yeah, we still didn't deviate with our business plan. We still moved forward to raise the rents. What we do was we offer the tenants, once their lease is up, and a lot of those leases when we bought them expired in like 3 or 4 months or so. So it didn't happen right away. We usually give them a 60-day notice. We say, here's your new lease offer. They try to negotiate with you all the time. And but the part of the negotiation is, what do you want in your apartment? Like, what would make you stay, and what would you like to see upgraded? You might be surprised. A lot of times tenants are like, yeah, I love a new toilet. That's it. Okay. Well, I'll do that tomorrow if you want.
You got it. Automatic flush.
So our retention rate, Randy, when we were going in there was 7 out of 10. And even during COVID, it was tough to find. People weren't really moving around anyway. So it kind of played to our benefit a little bit. And we would do some fancy things if people try to negotiate the rent, and, because they're like, oh, you can't kick me out. The whole thing was, it was really crazy experience, but we got creative with some security deposits. We gave them back their security deposits in exchange for the increase. So we did some funny things, but it all worked out. So, our occupancy rate, yeah, when you're doing renovations, it's going to go down, but in general, it's 85%, 90%, like all the time. Collection rate, even during the renovations, because it wasn't like we were getting hit with all 64 at once. It was, 5 in the month of August, and then 6 in, September. The thing is about Northern New Jersey and these units, they rented in once we put them up, they were gone in 2 days. If the tenants
usually
down.
you would just juggle them, right? You would do 2 and then take them 2 and put them in the new ones. And
yeah, but like I said, to answer Randy's questions, a lot of these tenants stayed, so the occupancy rate was high.
wow.
But that was
In New York,
also,
they would have said, we don't have to pay.
what's that?
If that was New York, they would say, we don't have to pay.
Well, they said that here. They did say that because the tenants, there was an eviction moratorium that was used as leverage against us. At the time, people didn't know what was going on, so we kind of got creative in terms of giving people, and we tried to do the right thing too. It was a crazy time, but we were able to give people back their security deposits. Some people had 2 months security, so that was like $3,500 for some people, and we were able to actually give that back to them, and basically give them a month free, and they signed up for tenant security deposit insurance instead. So we were still covered if they defaulted, but they got their money. They didn't have to give us back the security deposit. So the tenants just kind of saw that as, oh, that's pretty cool.
Free money.
Yeah, and especially during that time, it's we don't know what's going on, but you had to sign the new lease. That was the trade-off. And honestly, I think everybody did it. We did get pushback, but everybody did it. So, got to just get creative. Any other questions, commentary? I'm being pretty honest here, so.
I've got another one, actually. I'm not sure who, who this will apply to, but it's one that crossed my mind. As you said, you're in 6 states. It's clear that you've built a process around looking at new markets. And I was just curious, as far as you approaching new markets, like what are the top or maybe the first 1 or 2 things that you do when you're looking? Is it building up the list of brokers? Is it, looking at vendors in that market? How do you approach looking at new markets?
So I'll preface it a little bit this way. Before I started my company, some of you know this, but not all of you, I used to work for another real estate company, another sponsor. They were buying office buildings, and they bought in like 12 different states. So all the states that I was exposed to is now where I look. So, so familiarity helps. So while I was there, I did a lot of research. I would have never been in Florida, if I didn't work for them. I would have never been in Ohio if I didn't work for them. Getting familiar with the markets just through experience was great. But you always look at, okay, what are the top 10 net migration, in migration areas? Where are the jobs fleeing to? It was nice with the first syndications for them to be local, including some of my personal portfolio, for them to be local, because we were really hands-on. I told you, we were knocking on doors when tenants didn't pay, and trying to get them out during the eviction moratorium. It was good being local, and we did research locally, and then we just found out what we liked in our local market, and then we kind of just used that to look in additional markets. But in terms of like networking, and I think I got another question here from Mike. You would have you mentioned you would have never seen this deal if you haven't closed on your first asset. How do you get brokers to show you deals before you close on the first? So we had some other properties before we bought our other property in Newton, and I've been kind of networking with this broker for a while, who bought us this opportunity Jerry and I did together. So I think that's why he showed it to us, just because we had a track record. And again, as I just mentioned, I work for another real estate operator, so it's kind of entrenched in the community already. It kind of leveraged that as background. So for those of you who are getting started or whatever, it's good to team up with an operator, whether it's general partner, limited partner. And then, if you start looking at your own deals, you say, yeah, I partnered with, Red Knight, or partners with Jerry's team, and brokers take you seriously, and then they start showing you the good deals. At least that's how it's been in my experience. I hope that answers the 2 questions from Mark and Mike.
Absolutely. Thanks.
So I guess a good question. Now in terms of the current environment, right? What are you seeing? Are you seeing different attitudes by sellers? I mean, obviously, where was 6 months ago and how crazy things were going now? How different do you see the market right now? Where rates are and I guess some uncertainty overall.
Yeah, depends. There's a lot of money, liquidity still on the sidelines. A lot of money hasn't been deployed the past couple of years. So there's still demand, particularly for multifamily. I mean, industrial's hot too, still. For real estate, I think I have a theory after this whole crypto FTX thing. I think there's going to be even more money interested in hard assets. Just a lot of people got burnt with crypto. I don't know much about it, so just call me out on it if I'm wrong. But yeah, in the current environment, rates are definitely higher. You just got to hustle and you got to find better deals. And that's all I have to say. The next deal you look at has to be better than the one you just looked at. So, but yeah, you just factor in. We're recording this at the end of November 2022. my opinion is rates are going to be higher for longer than most people are expecting. I could be wrong, but we're just factoring that in. It's factoring in higher rates for longer. And if the numbers still work, then and the fundamentals are good, the basis is good, the market is good, the business plan is solid. You put good debt on it. Don't put floating rate, 18-month debt at 80% loan to cost on the properties. A lot of people have done that in the past couple of years, and now their loans are maturing and they might not have hit their business plan. So there might actually be some opportunities coming up. I'm already seeing some of it for acquisitions in 2023 to take advantage of that type of distress. So there will be some of that. I don't know if it's going to be that much on multifamily. I think you're going to see it more in office buildings. Already hearing a lot of rumblings with that. People are handing back keys. It's gonna be pretty nasty, I think, with office. But multifamily is fundamentally kind of, where I'd like to be, and that's why you have everybody's listening right now, so and interested in it. So it just got to underwrite more, smarter. Don't underwrite 10% rent growth every single year for the next 5 years. Just not going to happen. It's got to have a good. Really, the key in finding a good deal is what's the seller's motivation. That's it. If they are 85, we're buying a deal right now. Guy's 85 years old, original developer. It's in a good market. I can't really talk about it, for lots of different reasons, but it's in a good market, secondary market in the Southeast, and it's over 100 units, and it was built in the 80s, and he's developed it. We found it off market. He owns like 1,000 units. This is 100 units. He found out his kids they're not that interested in taking over the business when he eventually goes, because he's not doing that well, unfortunately. So he's having a hard time letting go of everything, but he was like, oh, let me start with this asset with the Red Knight guys, and if that goes well, maybe they could buy some more and whatnot. So we love buying from sellers who developed, never raised the rent since they developed, and the basis is still really good, and the yield on cost is really good, and we have the ability to put fixed rate debt, even if the rate's 6.5%. Do the numbers still work? Don't model cap rate compression on your exit. Model cap rate expansion. Do the numbers still work? Maybe model a longer hold period. Everybody's not living under a rock, especially, astute investors like everybody on this call. If they get what's going on, and they know things might take longer than what it was in the past to come back, hopefully to stabilize interest rates, kind of how they were before. But I think it's just going to take a couple years, at least. It's a good time to prepare and be liquid for what's about to come around.
Yeah, that's a good point. So this newer deal that you're talking about, obviously it probably came through a broker relation. Now, was it someone that reached out to you, or you were reaching out to brokers?
A combination of both. Yeah, combination of both. For us, we had some properties sell, including this one, where we wanted to redeploy the capital, and kind of we had a mailing list of brokers, so we were telling everyone what was going on, and it took a while. It took like 3 months to find this new deal, but it's you're just not going to find deals in 2 weeks. It's just not how it works. At least good deals.
Yeah. Any other questions? Anyone out there?
You think you would do the 1031 exchanges?
I would recommend, if you can, and you want to continue in real estate. If you don't, then don't do the 1031. But we didn't
the time limit that they give you to find another deal, that's under the crunch, right?
Yeah, if you are really serious about selling your property and you're going to meet the market, then you kind of plan for it in advance. We didn't do a 1031 on this deal specifically. We had a lot of partners. Pretty complicated. I mean, it's not that complicated, but it's more work to have everybody come in. We basically, my company would give people the option if they want to come in the next deal. The 1031, they don't really get an option. So we don't do the 1031 on the syndications. But what we do, at least what we've been doing, is buying the next deal and then using bonus depreciation. This is the last year of 100% bonus depreciation, by the way, and using that number to help, partially or hopefully fully offset the federal tax capital gain burden from the sale. So it's kind of similar, but it's not the same facility. You're not using an intermediary, and it's not the same process.
So are you invested in North Carolina now?
North Carolina, no, but I'm leading on Jerry for that.
Okay.
Gotta get you something, Anthony.
I do like North Carolina. We looked at, Jerry knows, we looked at something in South Carolina. It didn't end up going through, but I do like those markets. Yeah, absolutely, Howard. I have a question from Randy, I see. How do you select the PMs for your out-of-state properties? So for every 100 units, we have like 3 on-site employees. It's usually 2 maintenance, 1 head maintenance, 1 assistant, and then 1 leasing. Really, for relationships, we've gotten pretty lucky. Our first one we bought in Florida, we found the PM and the leasing through one of my partner's relationships. My partner played for Tampa Bay Bucks for a couple of years, football. That was actually one of his former teammates who hooked us up with the PM and the leasing and all that. So that was like our real first out-of-state one. Pennsylvania, I could get there in an hour. That really wasn't out-of-state. So that helped. And then when we grew and expanded, honestly, we kind of leveraged that relationship, and like we found other leasing agents through the leasing company we were using, and just kind of keep growing that network and applying it to other markets. But the thing is, we're buying in markets that we're familiar with, so we always know people in those markets. So we really ask for recommendations, referrals. We vet them out. They go through an interview process, and then we make a decision. We've had to hire and fire PMs. We've had to hire and fire maintenance, leasing. I mean, been pretty lucky. It hasn't happened a lot, but it has happened. We've gone through a couple on assets, but you know pretty quickly when they're not performing, and you kind of scratch your head. If they're not performing after a month, as you take them on, you get rid of them. We've always done that. So, and we try to treat everybody well and give everybody a chance, but you just kind of know when it's not working out on the PM side.
Quick to hire, quick to fire.
Yeah. It's the hardest part of the business. It really is. It's harder than finding deals. If I could find deals all day, I'd probably be much more wealthy, but we have the property management too.
We've got a couple of minutes left. Usually keep it to an hour, and then we break out. So I don't like to take up too much of your time. So if anyone else has any last questions, jump on. If not, I do. So we're talking about different markets, and what are some of the I think Mark kind of brought this up in terms of different markets, but metric wise, like obviously, like I just recently was down in North Carolina twice in the last 2 months, and it's just amazing to see the growth. Like Charlotte was one, and we were over in Winston-Salem, and it's just a different world out there. And Florida, I'm assuming, is the same. So what are some of like specific metrics you're looking at when you enter into a new market?
Yeah, I kind of mentioned this before when Mark asked the question, but population growth, number one, net in-migration, number two, employment growth. What's the employment sector look like? How, what's the industries concentrated around it? Any new developments coming in? We look at all that. And Mark kind of alluded to this a little bit before with the landlord friendly markets. We want to see if there's rent control. We don't buy in markets with rent control, otherwise my business wouldn't work. And you mentioned the Northeast being tenant friendly, which some parts are. This particular area of New Jersey, the only reason we bought it, there was no rent control. Most of the state, once you get into Essex County, kind of east of Essex County, south, north a little bit, there's a lot of rent control. So this is 50 miles from Manhattan. You're not taking a train. People aren't commuting to the city from there. So it was far enough where there was loose restrictions, but it was still in New Jersey. So we look at that. We look at the underlying fundamentals, but it does come down to the economy. We look at wage growth too. There's so many things you can look at.
So we'll take one last look at the chat here. I don't see anything else. Any last questions? If not, then definitely want to thank you for coming on. And again, from my perspective, awesome experience. And I think, just going back even to the walkthrough I did with you that time, and I saw how you already had connection with a lot of the tenants. And I think we went on a Sunday, and I learned a lot, like right there, like how, for the most part, people care about where they live if you treat them the right way. And you're running a business, but you also are have to make sure that it's a community and you're building communities.
Yeah, and honestly, most of the tenants appreciated it, and the ones that what we were doing of renovating the units and increasing the curb appeal and making the management better, like the previous management, if there was a running toilet or if there was a problem with their electricity, they would take days to respond. I mean, we had a guy on site and he was there, and I had an electrician. He was a certified electrician. He was my maintenance technician, my main one, and they would take care of it right away, and people appreciated it. They didn't care they were paying higher rents because we took care of it, and the people who complained, we didn't want there anyway, and they ended up leaving anyway at some point. So we really try to, there's a mission behind what we're doing too. Try to improve the community at the same time. The town loved what we were doing in this particular deal. I hope the new buyer kind of continues what we were doing, but I'm not really sure about that. When we go in, we really do try to work with the town and definitely change the perception of different areas, which is really, that's really fulfilling. So I really like that part about the business.
Yeah, actually, I was on a walkthrough last month, and it was the first one going in so in depth. And during the time, the police inspector and inspector of the town came in, and they knew that we were looking to purchase. And it was kind of interesting. Like they gave, he's kind of spilled the beans. It's like, hey, this guy has 20 violations, blah, blah, blah. We would love someone else to come in and fix this up. Like this area is actually what drags down this neighborhood, so it's getting involved with the town officials is something that's I never looked at it that way.
Yeah, and like you said, it's a for-profit business too. You got to make money, but it's nice to have a mission behind it.
Awesome, Anthony. Well, thank you. Any last one? Looks like nothing else in the chat, but I appreciate you coming on and let everybody know how they can reach you and drop your information in the chat. Sure. And that's the same thing for everyone else. Put your contact info in the chat. And I know you have a podcast and the website and everything right there.
We do. I put my info. Yeah, I'll stick around too if you're doing breakout rooms, but love to connect with everybody. I think Mike was asking if there's a recording of it. I think Jerry and I are both doing. Yeah.
Yeah, I'll send that out in a day or two. Cool. So yeah, everyone use the chat in here. Anthony, if you want to give me back the
Yes.
co-host, and then I'll break what I do is